Okay. Have you? Huh? Oh yeah. Funny. Funny. No, I'm joking. Hello? Night, babe. Trying to work something out on my computer. Yes. I love you. Good night, Summer. Summer, I'm literally live on YouTube. Bye. Right, we're recording now. So yeah, I was thinking, how could I actually explain these concepts in a way that's gonna make someone that's never heard of it make sense? And the only way I could kind of think of is to structure like this, and I've called it IIM. Okay, so all it is these in this order. So the idea of institutional candlesticks, you may have heard them as sponsorship candles or order blocks. It's all kind of the same thing, right? And this is going to lead to something called imbalance, which I'm going to go over. And the final result of these two will react in a mitigation, okay? But I'm going to go over what they will mean. Okay, so when I talk about institutional candlesticks, what I'm actually talking about is where the banks got in. Where did big money get in the market? Because they kind of leave evidence. Imbalance, bro. Yeah. Oh, I've spelled imbalance wrong, haven't I? It's all good. My spelling, you will see this time and time again. It's absolutely atrocious. Okay, so don't watch that. But yeah, institutional candlesticks are where big players got in the market, and they kind of leave. Right, we're recording now. So yeah, I was thinking, how could I actually explain these concepts in a way that's gonna make someone that's never heard of it make sense? And the only way I could kind of think of is to structure like this, and I've called it IIM. Okay, so all it is these in this order. So the idea of institutional candlesticks, you may have heard them as sponsorship candles or order blocks. It's all kind of the same thing, right? And this is going to lead to something called imbalance, which I'm going to go over. And the final result of these two will react in a mitigation, okay? But I'm going to go over what they will mean. Okay, so when I talk about institutional candlesticks, what I'm actually talking about is where the banks got in. Where did big money get in the market? Because they kind of leave evidence. Imbalance, bro. Yeah. Oh, I've spelled imbalance wrong, haven't I? It's all good. My spelling, you will see this time and time again. It's absolutely atrocious. Okay, so don't watch that. But yeah, institutional candlesticks are where big players got in the market, and they kind of leave footprints, I guess you could call them, right? I mean, it comes in these three ways. I'm gonna go over that right now. Okay, so when we talk about institutional candlesticks, what we are talking about are the big ones, essentially, the big ones. Like this one here, this is a big one, right? Like that much volume doesn't just enter the market without a kind of source, without a cause, okay? So when we're talking about institutional candlesticks, they come in a lot of different forms. I'll get so many messages right now. Okay, so the first one, we could bring back the idea of that FE candles. I've drawn this for you guys so you can kind of see. So do you remember on our first session when we talked about the idea of the liquidity pools, right? And how resting liquidity gets taken by big money. They come up, see these equal highs right here? Let me mark these out just like this. We call these equal highs. Say we're looking at the weekly right now. Say we go down to the daily. They used to be really, really nice equal highs, wouldn't they? Okay. And then we get this candle that comes up to take out these stop losses. That's a footprint of the banks. That is a footprint of institutions getting in the market to take from the retail traders. But we got to understand is when they take this liquidity, they use it, right? Like I said, we got to look at this drawing, what I've marked out as a big downtrend. I didn't want to draw out so many candles, so I just drew it like this, okay? So we're looking at a big downtrend. And what did I say about structure? They use that liquidity to create structure. So as they take liquidity at the lower high, they're going to use that liquidity to push the market in their desired direction. It might be because we're looking at the weekly right now, but on the monthly, there's demand down here that we need to reach. What we got to understand is the market is fractals. So you're going to see this across all time frames, all these ideas playing out, okay? So when we get that big push up to take the stop losses, then that big impulse after, it's going to leave something in the way, okay? And it's called imbalance. I'm going to go over what imbalance is first before I come back to marking out where you would mark out the institutional candle. But imbalance is something that you should definitely backtest after today because everyone can see it, everyone can identify it, but not everyone knows about it. And it's such an important thing. Like, let me take you guys to the daily time frame, okay? I'm going to show you guys something. So we have what we call healthy price action. And what we call healthy price action is just the idea of wicks, okay? Wicks overlapping wicks. So do you notice whenever price moves, no matter what time frame you're on, 95% of the time there will be a wick coming down to kind of fill each other out. So when the next candle's formed, there won't be any gaps, if that makes sense. And so I was to mark out some gaps for you guys, I can do it right now. So right here, do you see this gap? A gap in the market where wicks don't come to kind of fill in. Because there's no
There's no password.
yep. Okay,
Okay,
Peter, can you
or
deal with that for me? Thanks, man.
is there a password? There's
No, there's not a
no.
password. Everyone could just join, right? I'm guessing there wasn't no password. Okay, so yeah, imbalance, and the reason it's imbalance is because do you see how when price moves, wicks come back to overlap where the gap should be? Well, obviously, right here, these wicks don't come low to fill in. This is what we call an imbalance in price, and the reason we call it that is because there was only sell pressure within this time frame, within this period, right? So what you got to think is within this daily candlestick, there were only sell pressure. There wasn't any buyers, and that's called an imbalance in the market. And imbalances always get filled. It's the golden rule, right? Imbalance always gets filled. So say I was to move this along. Do you see how eventually, even if it was months later, price come back to fill in that gap? Okay, I'm going to see that over and over and over again. So you see this little gap right here. Remember, all time frames you can see this. You see how price eventually will come back to. I can get in there. Price will come back to fill it. Okay, all the time. And you guys can go back test this, see it for yourselves. So you see all this imbalance up here. Like here, you can't really call this imbalance because it's such a small zone. But at the same time, it is imbalance. Okay. So let me just mark out this big one for you guys. Do you see what there's no healthy price action. It's just sell pressure, no bullish candles to fill in these gaps. See how this gap got completely filled before the continued bearishness happened, okay? Or bullishness, okay? You're going to see this time and time and time again, and I can keep showing you guys. But the whole reason I'm bringing this up to you and why this is significant is one, you can use it to your advantage. Wherever you see imbalance, you can understand it's going to get filled, so you can anticipate price coming back into these regions before you get the move you're anticipating, okay? And the second reason is because this is a sign that big money got in. So if I go back to the, is it 1 month? I fucking want 1 month. Okay, yeah. So I'm gonna go back to our little chart. Okay. So right here, this is where the idea of the institutional candlesticks taking liquidity then creates imbalance. Okay, because once they take that liquidity and have all this money to move the market in whatever direction they want to, in this case bearish, they're going to use it to create these big candles just to continue price in the desired direction. Also to fill out previous orders. Remember, the markets, you guys have probably heard the term of hitting two birds with one stone. These guys like to hit 1,000 birds with one stone, okay? So everything they do has a reason, and they're either closing orders, moving price how they want to, taking the liquidity to continue in a direction. It's all going to have a reason, right? So even this candle here that took liquidity from these guys, this is coming up to close orders here where there might have been imbalance. There might have been more supply they needed to come to. And I'm going to go over supplies today as well, ever so briefly. When we go through this, I'm going to go through how supply and demand implement into what I'm talking about, okay? So like I said, these institutional candlesticks create this imbalance in price. I'm going to mark that out for you right now, okay? Imbalance. So do you see that right there? Can everyone just put a 1 in the chat if you understand this idea I'm going on about as imbalance? Okay, I'm seeing ones. Okay, cool. Nice. Okay, cool. So then what imbalance actually leads on to is, well, I say imbalance. What institutional candlesticks and imbalance? So these guys that they give away that the banks have got in and then shifted the market with these big candles, right? So where's the big ones? Whenever you see big candles, you know, right? The banks are in. This is a pair that the banks are in. Right, we're recording now. So yeah, I was thinking, how could I actually explain these concepts in a way that's gonna make someone that's never heard of it make sense? And the only way I could kind of think of is to structure like this. And I've called it IIM. Okay, so all it is these in this order. So the idea of institutional candlesticks, you may have heard them as sponsorship candles or order blocks. It's all kind of the same thing, right? And this is going to lead to something called imbalance, which I'm going to go over. And the final result of these two will react in a mitigation. Okay, but I'm going to go over what they will mean. Okay, so when I talk about institutional candlesticks, what I'm actually talking about is where the banks got in. Where did big money get in the market? Because they kind of leave evidence. Imbalance, bro. Yeah. Oh, I've spelled imbalance wrong, haven't I? It's all good. My spelling, you will see this time and time again. It's absolutely atrocious. Okay, so don't watch that. But yeah, institutional candlesticks are where big players got in the market, and they kind of leave footprints, I guess you could call them, right? I mean, it comes in these three ways. I'm gonna go over that right now. Okay, so when we talk about institutional candlesticks, what we are talking about are the big ones, essentially, the big ones. Like this one here, this is a big one, right? Like that much volume doesn't just enter the market without a kind of source, without a cause, okay? So when we're talking about institutional candlesticks, they come in a lot of different forms. I'll get so many messages right now. Okay, so the first one, we could bring back the idea of that FE candle. So I've drawn this for you guys so you can kind of see. So do you remember on our first session when we talked about the idea of the liquidity pools, right? And how resting liquidity gets taken by big money. They come up, see these equal highs right here. Let me mark these out just like this. We call these equal highs. Say we're looking at the weekly right now. Say we go down to the daily. They used to be really nice equal highs, wouldn't they? Okay. And then we get this candle that comes up to take out these stop losses. Hmm. That's a footprint of the banks. That is a footprint of institutions getting in the market to take from the retail traders. What we gotta understand is when they take this liquidity, they use it, right? Like I said, we got to look at this drawing, what I've marked out as a big downtrend. I didn't want to draw out so many candles, so I just drew it like this, okay? So we're looking at a big downtrend. And what did I say about structure? They use that liquidity to create structure. So as they take liquidity at the lower high, they're going to use that liquidity to push the market in their desired direction. It might be because we're looking at the weekly right now, but on the monthly, there's demand down here that we need to reach. But we got to understand is the market is fractals. You're going to see this across all time frames, all these ideas playing out. Okay. So when we get that big push up to take the stop losses, then that big impulse after, it's going to leave something in the way. Okay. And it's called imbalance. I'm going to go over what imbalance is first before I come back to marking out where you'd mark out the institutional candle. But imbalance is something that you should definitely backtest after today because everyone can see it, everyone can identify it, but not everyone knows about it. And it's such an important thing. Like, let me take you guys to the daily time frame, okay? I'm going to show you guys something. So we have what we call healthy price action. And what we call healthy price action is just the idea of wicks, okay? Wicks overlapping wicks. So do you notice whenever price moves, no matter what time frame you're on, 95% of the time there will be a wick coming down to fill each other out. So when the next candle's formed, there won't be any gaps, if that makes sense. And so I was to mark out some gaps for you guys, I can do it right now. So right here, do you see this gap? A gap in the market where wicks don't come to kind of fill in. Because there's no
There's
uh
no password.
yep. Okay,
Okay.
Peter, can you
Or
deal with that for me? Thanks, man.
is there a password? There's
No, there's not a
no.
password. Everyone could just join, right? I'm guessing there wasn't no password. Okay, so yeah, imbalance. And the reason it's imbalance is because do you see how when price moves, wicks come back to overlap where the gap should be? Well, obviously, right here, these wicks don't come low to fill in. This is what we call an imbalance in price. And the reason we call it that is because there was only sell pressure within this time frame, within this period, right? So what you got to think is within this daily candlestick, there were only sell pressure. There wasn't any buyers. And that's called an imbalance in the market. And imbalances always get filled. It's the golden rule, right? Imbalance always gets filled. So say I was to move this along. Do you see how eventually, even if it was months later, price come back to fill in that gap? Okay, I'm going to see that over and over and over again. So you see this little gap right here. Remember, all time frames you can see this. You see how price eventually will come back to. If I can get in there, price will come back to fill it. Okay, all the time, and you guys can go back test this, see it for yourselves. So you see all this imbalance up here. Like here, you can't really call this imbalance because it's such a small zone, but at the same time, it is imbalance. Okay, so let me just mark out this big one for you guys. Do you see where these? There's no healthy price action. It's just sell pressure, no bullish candles to fill in these gaps. See how this gap got completely filled before the continued bearishness happened, okay? Or bullishness, okay? You're going to see this time and time and time again, and I can keep showing you guys. But the whole reason I'm bringing this up to you and why this is significant is one, you can use it to your advantage. Wherever you see imbalance, you can understand it's going to get filled. So you can anticipate price coming back into these regions before you get the move you're anticipating, okay? And the second reason is because this is a sign that big money got in. So if I go back to the is it 1 month? I'm talking 1M. 1 month. Okay, yeah. So I'm gonna go back to our little chart. Okay. So right here. This is where the idea of the institutional candlesticks taking liquidity then creates imbalance, okay? Because once they take that liquidity and have all this money to move the market in whatever direction they want to, in this case, bearish, they're going to use it to create these big candles just to continue price in the desired direction. Also, to fill out previous orders. Remember, the markets, you guys have probably heard the term of hitting two birds with one stone. These guys like to hit 1,000 birds with one stone, okay? So everything they do has a reason, and they're either closing orders, moving price how they want to, taking liquidity to continue in a direction. It's all going to have a reason, right? So even this candle here that took liquidity from these guys, this is coming up to close orders here where there might have been imbalance. There might have been more supply they needed to come to. And I'm going to go over supplies today as well, ever so briefly. When we go through this, I'm going to go through how supply and demand implement into what I'm talking about, okay? So like I said, these institutional candlesticks create this imbalance in price. And I'm going to mark that out for you right now. Okay, imbalance. So do you see that right there? Can everyone just put a 1 in the chat if you understand this idea I'm going on about as imbalance? Okay, I'm seeing ones. Okay, cool. Nice. Okay, cool. So then what imbalance actually leads on to is, well, I say imbalance. What institutional candlesticks had imbalance? So these guys that they give away that the banks have got in and then shifted the market with these big candles, right? So where's the big ones? Whenever you see big candles, you know, right? the banks are in. This is a pair that the banks are interested in. Expect manipulation. So once you see these two as a couple, you can then expect something called a mitigation. And this deserves its whole day of talking about, right? But I'm gonna go over it very briefly, okay? So when we see this, when we see this happening, that liquidity created, liquidity taken, and the liquidity moved down, something interesting has happened here. Because like I said, the banks are moving the market and the banks take liquidity to move it, okay? So what you got to imagine is the banks need to get down here. So I'm going to draw a line and just use this idea in your head. The banks need to get to this black line, okay? And they need to get here because they need to buy whatever this pair is at this price. They need to buy it because they know how it's going to make them the most money. So overall, they need to get back to this line, okay? So they're going to take this liquidity. So they're going to use their liquidity to then pump price up. They're going to pump price up to take these stop losses, okay? That's what they're going to do. So we got to imagine right now, they're going to draw a line, is they've pumped price up at the open of this green candle, haven't they? Okay? So right where this black candle is, this is where they've bought. So I'm going to make this line green so you can understand that. The banks have bought at this point, okay? So they're in a buy. Imagine you're the banks, you opened your MT4, even though they don't use MT4, you've opened up your MT4 and you've bought here, okay? So they're bought up to take this money, the money right here. Let me draw that out for you. I want to make this as clear as I can. So these equal highs here holds money, okay? Let me go back to this. Okay, so you bought here, you're in a buy to take these stop losses, and then also they've sold here. They've used that liquidity to hedge in a sell. Oh, I didn't even click on my thing. They've used that liquidity to hedge in a sell, okay? You don't need to understand that there might be things you're thinking right now, like this doesn't make sense. How can they burn a buy and a sell? Okay, just understand these are the market makers, they can, okay? And this is how they do it. So they've bought here and they have sold here. Just like let that sink in a second. I'm gonna say it a couple more times. They've bought here to take liquidity from these guys, and then they've them sold here. So they are now in a hedge position. But as you can imagine, price is moving down. They've used that liquidity to push price down. We've had a redistribution and a continued push down. So they're doing really well in this sell, okay? Understanding that the banks are trading with thousands of lots, they're in very big profits at this point. When we get to this candle, they're in big profits, okay? And this is where they're going to take profits on this sell. This is where they're going to close the liquidity and take the liquidity out of the markets on this sell. So what might be in the back of your mind is, what about this buy? If they're in a buy as well, what if they're in a sell and a buy? Surely that means this buy is in drawdown. Understand that this buy is in drawdown because they're in a buy here, and even though they've sold here to push price down, this buy that they've had, that's still open, okay? They've still got an open buy with as much drawdown as they're in profit. So what do they need to do? They need to bring price back to that exact point where they opened that liquidity grabbing candle, so they can break even on this buy as well as taking profits on this sell. And let me walk you through how they do this. Okay? So as they buy, they're going to have an open position, and as they sell, they're going to be in profits. So they're using that liquidity again to fuel the markets in this downwards motion, okay, in this downtrend. And remember, they needed to get here on some other time frame for whatever reason. So what actually happens is when they get to this point, they're going to take profits. They're going to take the liquidity out of the market they made on this sell. And what is that going to create? It's going to create something called an automatic rally, an automatic area in price where there isn't going to be as much sell pressure because they've taken all those millions of lots out the market. There's now no longer that much sell pressure in that market because remember, there's going to be a couple major banks that control this swing, and they're all going to be on the same page. They're going to be in contact with each other. They all have the same agenda, okay, to take money from retail traders. So once they get to this level and all these different banks are then taking their sell lots out of the market, that means there's going to be more buyers because the main move was the buy, obviously, but they took their sell lots out of the market. So it's going to cause this reaction. But at the same time, this move down, same thing again. Do you see how I've kind of marked how it made it look like this is liquidity? The banks have then come down. This last point where they've took profits or whatever, they're going to do the same thing. They're going to pump the market down, take liquidity, and use the liquidity to move the market in their desired direction. But anyway, it doesn't matter. You're going to have a reaction once it hits their take profit level. And what do they want to do? They want to bring price back to a nice lower high to continue going down. And where is it going to make sense for them to do it? Where is it going to make sense? It's going to make sense for them to come back to the point exactly where they got into that buy. Because remember, they're still in drawdown on this buy. So they need to come to the point, to the open of that candle, because this is where they bought the open. So they're going to come back to the open to break even on this buy, so they've lost absolutely nothing in this trade that they made, and then they're going to continue the trend going down. And the imbalance is also significant because an imbalance in price always gets filled. So you often find imbalance after these institutional candles. Okay, I'm hoping this is making sense. It's going to sound complicated at first, but something like this, it's like learning a new language. Learning a new language. Okay, you're going to need to hear it a couple times before it makes sense. And you might not like the fact, but I'm not going to lie to you guys. If this is sounding complicated and you're thinking to yourself, I can't be bothered to come here and listen to all this stuff, then this isn't for you. Okay, it's something that is going to take time. It's not going to happen overnight. You need to hear what I'm saying. You need to come back to these calls every day. You need to back test. You need to be active on market hours. Be active at London session, New York session. See what happens when these moves kind of take out. Okay. So what I'm going to try to do now is show you some examples of this happening. Okay. So I'm going to go to a different pair because I don't think this pair is the best for it. So I'm going to try to show you areas where the banks got in, imbalance was created, and then price come back to mitigate. And before I do that, what you have to understand is the institutional candlesticks don't just come in forms of liquidity grabbing candles. They come in other forms like this. This is a redistribution of price on a lower time frame. So this is going to be where banks were last in the market to close orders or create more liquidity to keep the push down or whatever. So candlesticks isn't something we're going over today. We're just going over the simple concepts of what these words mean. I can show you the candlesticks maybe tomorrow. It makes sense. I'm kind of getting tomorrow like as doesn't make sense. But I'm trying to. What am I trying to say right now? Like every time I'm doing one of these sessions, I kind of gauge what we need to look at tomorrow. Okay, so just following what's going to make sense for you guys, we're going to go over candlesticks tomorrow. Okay, so right now I'm going to show you examples of institutions getting in, imbalance being created, and then the idea of mitigation happening when price comes back to the exact point where they took liquidity to then continue in whatever trend they was in. So let's go to a nice pair. Oh, didn't need to do that. Let's go to our watch list. What's a nice pair? We'll go to Euro USD. It happens so much.
Yo, Luca, you have very good question in the chat. Somebody pointed it very
Oh,
nice.
have I got some questions? Okay, let me have a look. Was that a long one? Okay, let's go back. Let's go back. Let me not move on too fast. I should have read comments. Really, my bad. Um, let's see. Oh, wrong pair. Okay, so let me go over these questions one more time. Okay. Would that long green one be also imbalanced? The long green one. Yeah, this long green one. What most likely would happen here is you'd get a pullback. Like you'd get a black candle and it will come down to fill the imbalance on the way up, if that makes sense. But otherwise, yes, it would be imbalanced. That long green candle would have created imbalance. So after the banks took liquidity from these guys to continue the downtrend and the big green candle happened, they used this liquidity to pump the market back up. Yes, there would be imbalance inside this candle, and that institutional candlestick would have then created imbalance to then be mitigated, and then what you'd get is just a lower time frame, lower high, and just to continue downwards. Does that make sense? There would have been imbalance in that green candle, yes. Is that why fake outs happen? Because the resistance is broken, so everyone buys, and then the market creates downwards pressure to all those people that got stopped out. You hit the nail on the head, bro. Okay, so let's go through the idea of retail traders. How do I get off this? Go away. There you go. Okay. So yeah, that is exactly why if you type on Google forex, they'll give you support and resistance because every time, say this is your resistance line, okay? Every time price comes back to revisit this line, it's forming more and more opinions. Every single time it comes back to test this line, more and more people are thinking, yep, sell, 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 sell. So that means after a certain amount of times, there's so many people selling off one line. There are so many stop losses above, so many stop losses, so many buy stops, stop losses. It's crazy, right? So that's why they use that resistance to then break through, take the liquidity. Because what you got to think, I said it yesterday, okay? The forex market, foreign exchange market, is just a transfer of money. Every time you lose £100, someone else has won it. Okay, does that make sense? So that's why the banks are taking the money off retail traders that are using support and resistance. That's why like people say it's a manipulated market and they won't trade it. That's why if you ask a stock trader, why do you trade stocks not forex? There's more money in forex. It will say, it's manipulated. Like you can't trade it. It's impossible. But this is why knowing this stuff is a huge advantage. It's basically like someone saying to you, "Do you want to be a millionaire?" And you being like, "Yes," and they're gonna say like, "Okay, follow me. I'm gonna teach you this." It's crazy. If you really want to learn this stuff and you practice this every day and you go find out more information where you can, I mean, it's gonna change your life. Okay, understanding this stuff. So yeah, that question was you hit the nail on the head, bro. Exactly that. Okay, so let me move on. Let me try to show you some examples of this happening. But let me tell you now, it won't be as clean as this. I'll try to find some as clean as I can. But remember, this is off the top of my head. We're freestyling right now. So let's go down to the say 30 minute. We see some nice opportunity. Okay, 15 minute. Why not? Okay, so let me actually go over AUD. I like this pair. Kind of has nice trends. So okay, let me see. I want to try to find a real nice example for you guys. Okay, yeah. So looking at this area where price has reacted, okay? Just understand what happened. I'm on the 15 minutes, so this is quite a small time frame. So when we look for those candles that took liquidity, sometimes they don't actually have to take that much liquidity. They can happen for other reasons, okay? But what we're actually looking for when we're looking at this reversal is the area where big money got in, the area where hedge funds had realized what the banks were trying to do and kind of rode the waves and got in. So right here, let me show you guys something. So this last black candle, do you see this? This last black candle before we get these big ones. So you see how we get these big free impulsive candles? This is showing us something. And the fact that we broke this 1 minute structure area and we created resistance line. So think about that. Remember how I said the banks are always trying to hit 1,000 birds with one stone? They're doing that everywhere, okay? So think about what they did. We had this last black candle here that was unmitigated. Remember with mitigation, it was the idea of price coming back to that point where they last sold. So this is the last sell candle, okay? This is the last area where we had where we the healthy price action stopped. Remember how I said about healthy price action? The wicks always coming back to overlap. This is healthy. As soon as we get these three candles, and as you can see, like it's only a small one in this one because this is the first one I found. You see how there's that imbalance left. So that could be telling you, right, price is gonna come back to fill this imbalance, okay, no matter what. And you see how up here it kind of created this triple top. So when it does get back to this point, people are gonna be trying to sell. And like the same thing you could say about a trend line, like something like this or something like that. You know, people are gonna do all sorts of kind of crazy stuff. And at the same time, what else has it done? Like it's created what people would see as a trading range. Okay, there's gonna be people buying, selling, buying. It's crazy. So, if anything, you could call this the liquidity grabbing candle, and this probably got mitigated, which I'll go over in a second. But that doesn't matter. Right here, you get that last kind of candlestick, and this is a valid candle. Okay, this is a candlestick we look for. Let me just break down for you guys. We only look for a certain few candles when we're looking for the strategy. Okay, but again, I'm gonna go over what those candles are tomorrow. So this is actually a candle we look for, and this is what we call a drop-based base rally. Like we had sell pressure right here before the big buyers came in. You see these four large candles. That's sign of institutions. Okay, also imbalance. So as I am to mark out this last sell pressure before the big candles, do you see how price come down and respected that area perfectly? It filled the imbalance and come and closed orders at the last place they sold before the big orders pumped in. Okay, they come back to the open of that volume. Do you see how, if you even think about it in a really logical way, like I said earlier, think about it. This, this where the top of the box is, and this last black candle. If you're looking at this last black candle, we look at the top of the base. We've got the base and the wicks, okay? And the top of the base is where it opened. This is where this candle opened and they sold, okay, before they bought at the same time. Remember, they don't set stop losses, okay? It doesn't work like that. So they sold here and then they bought here. They're in drawdown on the open of this candle. You see how price come down and respected the open of that candle perfectly to then continue the orders going up. And the fact that it created liquidity here, okay, for me personally, I would have only taken this trade if it may be actually saying that I would have taken this trade because there's clear liquidity there. But what we look for to see strength in the market is a break of these structure points to show strength, to show structure is changing. But right here, this would have been fine to take a buy here because what you need to understand about these zones is it might not always have a very strong move, but it will always have a reaction. And that means it will always give us a chance to put our stop loss at break even and take profits. So it doesn't actually matter if you don't get the full move off your area because these are small zones, okay? And our risk to reward is that great that it doesn't matter if you lose 10 times in a row. So this is a trade we would maybe look for taking when price comes down, comes to the open of the sell pressure to close any orders they had to continue going up. But then again, the story repeats, okay? I haven't looked right. This might not work out, but do you see right here, this big black candle that took liquidity from these guys, and then after we kind of got these candles, and then we got the push up. So ask yourself, okay? Ask yourself about the concept of healthy price action. What does that mean for us when we see these big candles? This is obviously where they got in again, okay? They got in again here. So we had the big wick down, that's taking liquidity. We then pumped price up. Then we had healthy price action because we come back down into this wick to then come up again. And we had a last sell pressure right here. So when we're looking at areas where price could come back to continue going up, we'd be looking here because this is our last sell pressure before all of these structure points were taken. So this holds strong demand. There will most likely be a reaction from this candle. Remember, I can't remember what it looks like over there, so I could be completely wrong, but I'm just going to show you how accurate our strategy kind of is. So then we also got this. This could be something I might want to return to, right? So when we actually look, right, okay, you see this. I don't think we made it all the way down, but you see how price come down to fill a lot of the imbalance. In fact, it come down to these points here, but you could have marked out your imbalance and price come down to fill the imbalance. And I'm sure if we go down to a smaller time frame, there'll be a reason why price came here. So let me see if I can show you that. So yeah, we haven't returned to this point. So what I'm going to do is box up this area. Oh, can you see that? Box up this area in a blue box. Blue box to do because are we quite fast? So let's go down to the 5 minute. Didn't really need to do that, but yeah, it's cool. So let me see. I reckon it's going to be something to do with the 1 minute candlestick, to be completely honest. So, let's go to the 3 minute. I'm going to find it, don't worry. Must be 1 minute price action. It has to be. Hopefully we can see back that far. Okay, cool. So yeah, you can actually see it. You can see it. So what you guys need to understand is I'm going to go over more basic examples. I'm just kind of drifting right now, but I need you guys to kind of see this. So when we look at these impulsive candlesticks, what often happens is you get these last little areas, these last little wicks to wicks, these last areas. So if say I went to the 30-second time frame, what we'd see is a base here. We'd see one of these little black, I think people call them spinning tops or doji candles. See these right here, these sorts of candles. Inside this, say we could go to the 30-second, we'd see another one of those right
Pin
here.
bar.
Okay? Pin bar candle, yeah, you could call it that.
Yeah, I'm calling it pin bar, and it's my most favorite entry, by the way, on lower time frame.
I know, pin bars are cool. So you got to ask yourself, why is this significant and not this one down here? And I'll show you because you see these structure points. See these structure points right here. These are what are important. It's the thing that broke the structure that shows where they got in. And what you could actually say, I don't know if he was on my call yesterday, but what we look for is the candle that reacted from supply. Okay, so this had been the last point of supply, filling up all the imbalance, following healthy price action. We got that small reaction, but then we broke straight through as of this point. So that's why price didn't exactly make it all the way down. But that's a story for another day again. I'm gonna show this stuff to you guys. 4 minute time frame at work, but you don't actually need to understand it fully. So when I mark at this zone, this is where we come back to respect. Okay, we didn't exactly make it all the way down, but it happens sometimes. So going back to the idea of these simple concepts, let's look at the Euro USD. It's always a nice pair of just clean price action. Okay, this is a nice little area. Just I'm showing you guys different examples, different ways it presents itself. But this little 15-minute swing right here, you gotta be cool, see it in all these different ways. So when we look at this, do you see how this is healthy price action? Do you see how price comes down, comes up to fill any imbalance that might have formed like this? And we've got these last up candles, and now this is the open of the buy before the sell, and price comes perfectly back to the open. Okay, that's healthy price action. See the same thing again here. Price comes back to this point. When we got this big candle up, okay, this green candle on the 15-minute, on the 5 minute or the 3 minute, there would have been liquidity here, okay? Price has come up, take this liquidity, and you see how price comes back to come to the open perfectly. Same here, this black candle. We got the base of this black candle that come back. This is what we call this. This is what we call order flow. This is the flow of orders. This is the flow of institutions using the liquidity to push market down and then come back to the point where they bought to sell. They buy to sell. This is why we call it buy to sell and sell to buy. The banks buy to sell and sell to buy. Right here, they bought to continue the sell, took profits where they needed to, and then come back perfectly to close that buy order so they can break even. Same thing here. That black candle that come up, that open, I suppose the open would actually be the top, but it come back perfectly. Same thing. Same thing here. You see the open of this green candle that come back to it perfectly. And right here, really nice example of the liquidity being made. Boom, they take the liquidity to push the market down. And you see how this is mitigated. Imbalance was left right here, but this was mitigated because this was next to the mitigation. Again, this is what we call order flow. So we got this green candle come to mitigate this, and then do you see how imbalance was created? Imbalance got filled, and then this come to mitigate this. It's just following mitigation, and it's whenever you get something like this, okay? Whenever you get something like this, where the mitigation happened, and then we get this, we get imbalance left. Balance is left. So I don't know if prices come back here yet, but this is somewhere where we'd expect the price to eventually come back to. And this is why people that got in maybe here somewhere, this is why we call them impatient, because there was imbalance above where they got in. So they should have expected price to come back to here. So this is what we call internal liquidity or inducing liquidity. So let me actually have a see. I don't know if price come back. Yeah, but it did. Okay, so when we got here, do you see how we got that reaction? Obviously, at this point, demand was in control, so we didn't want to continue bearish. But we did eventually come back and feel this imbalance, and we should have got a reaction from this area. So from this candle, there should have been at least a bearish reaction. And you see how we come in and we get this wick. That was the reaction, okay? And then we got, okay, so this is just following. Now we're looking at this concept again, the idea of supply and demand being in control. And we had this area that was unmitigated. Isn't it funny how we created liquidity? So this right here, do you see how price had a rejection here? And then retail traders automatically seeing this high and this high as a resistance line. So they tried checkmate the banks and try getting a sell, and they just got completely violated. And again, the idea of when we come into supply and then we get that reaction, and then it's whatever broke the supply area is where the banks are going to come to next. So what I want to do is I'm going to show you this again. So let me do that just so I don't miss out where I am. Go to this. We'll go to the 5 minute, just so we can see a little bit more information. So, okay, nice. So right here, do you see how this was the area of supply? When we got the reaction from supply, then we broke it. So this black candle was the reaction and the cause of what broke into it. So what you can do is mark out this black candle. And this is an area of demand, okay? And do you see how, let me bring it down, including the wick. Do you see how this is kind of used? Price come back into this zone, because this is the last area where they sold to buy. And this is why we get the rejections in this zone. And then same thing, we went down to the 5 minute, okay? We went down to the fractals, okay? So right here, what do you see? You see sideways moving price action, and then we get these big candles out of nowhere, this big candle. It's healthy price action. Then we had imbalance formed, imbalance right here. And then what else do we have? We have this last black candle. And why is this black candle significant? Because it's the last area where the bank sold before the big buy happened. And what happens? Let me get rid of this. Price comes back into this zone to fulfill the healthy price action to close this sell to buy. They took profits on the buy at these highs, but they also broke even on this sell right here. They come back to the break even point so they could close their orders to continue going up. And I can show you the same thing and go over again. So what have the banks done at the same time as fulfilling this upwards trend? Formed opinions right here. The formed opinions with bringing price to the exact same supply level to create something called resistance, okay? So how many traders try to jump the gun and be smarter than the markets and think, yep, it's only touched twice, but it's still resistance. And then boom, they just got stopped out quicker than anything, okay? So what can you actually mark out in this area? That last black candle, this is a rally, base rally. So this area here will be our area of interest, okay? Because institutions obviously got in here. Jesus, look at the imbalance. It's crazy, okay? And then what do we have? this last sell pressure, okay? Because all this is healthy price action. Right here, you get mitigation. This last black candle, okay? Got mitigated by this one. And we got these last bases right here, mitigated by these guys. But then this is when the move happened, and these aren't mitigated. They didn't come back to close off the sell. Remember, they sold and bought at the same time. So this is in drawdown and is imbalance. That's why they say imbalance always get filled. You might have heard these guys as fair value gaps or just gaps, or I can't remember what someone else called them, but it was something stupid. But no, imbalance in price, that's what it's called. So this is now an area of interest. And you see how price comes back to that point to close these orders. And I'm guessing you guys have already gathered the importance of this knowledge, okay? What could you do now you know this? What could you actually do? Like when you see impulses getting in the market, and then you see imbalance, and then you see areas where the banks clearly have had healthy price action, mitigate everything, but there's something unmitigated. Then your entries go from looking like this, a 1-to-1, and making 1% of your account off the trade, to this. Like you might have took profits at this high structure point, knowing you're in a nut trend, and that's a 1 to 7. You made 7% of your account, 7%, just like that in about, what are we looking? About 2 hours, 3 hours. Okay. I'm just gonna check the comments before I restart the call. Can you show us wrist will be on that move? Yeah, exactly. Easy. So guys, the call's got 1 minute left, so I'm gonna send a new link to everyone. All the groups you got this from, there'll be a new link sent. So I'm gonna end it right now. Start it out right away. I'll see you guys in a second. Yeah.
I mute everyone.
Okay. Okay. We'll get started at say 12 people.
Yeah, let's go.
We could just get started now. Let me just check I've sent it to all the right group chats. Yeah. Okay. Capital. Oh, 39. Okay, cool. Yep.
If anybody have any question, guys, just drop it. Ask to everything. No question is stupid question. So ask for everything, which not true.
Yo. Okay, we're all back now. Okay, cool. So can I just get some ones in the chat if you guys are kind of having some sort of breakthrough right now, thinking, oh, this actually makes sense. It's not gonna 100% make sense because there's so much you guys need to know. But we're gonna get there, okay? Because when I say we're gonna get there and there's so much to learn, there is, because this stuff, essentially, the skill set of understanding these areas after I've showed you everything isn't too hard. It's not hard at all. But what is hard is having the right psychology and being on the right side of the market. I think my little brother's about to run in my room again. 1 second. Okay, no worries. He's gonna run back up in a second. It's all good. So yeah, like I say, there's so much more to learn because you can apply all this stuff, but if you don't understand simple ways of the market, uptrend, downtrend, impulse correction, you're never going to be on the right side of the market because these small time frames they change all the time. Remember, we're looking at minor structure playing out right now, and it's all playing a part in the bigger picture of major structure. So it's important to understand what's going on with the higher time frame, where price is trying to get to, where the next points of supply and demand are. Because if you don't understand this stuff, you could see like this right here and think, yeah, you got imbalance. You got that last point where the banks bought to sell, and like price will come and just stop you up because you're not on the right side of the market, if that makes sense. But we're gonna get to that stuff eventually, so it's no worries, okay? But for now, what we're gonna do is continue forward in this chart. Completely, I'm not sure what it's gonna do, but we're just gonna see what we can see, okay, and see how price action is kind of playing out. I'm gonna kind of teach you guys what to be looking for, okay? So what I'm gonna do is go back to the 30-minute, just like that. Okay, so we see all this, and then yeah. So actually, instead of that, does anyone want to give me a chart? Just go from top down. Do not give me gold because gold is one of them pairs that kind of has a lot of complex pullbacks, leaves a lot of unfilled imbalance. It moves different to a foreign exchange pair. So does anyone want to drop a pair and try? I'll go from the big time frame and show you how we kind of GA. Okay, that's really good. That's really good. Yeah, I like GA. GA is cool. So let's go to GA. Just like that. I did it right. Yeah, I did it. I bet I've got so much in this pair. Let's go to let's start the monthly. Mine looks like GJ. That's funny. Oh, let me see that. I meant to do this. So when we're looking at GA, we need to ask ourselves, what is it doing? What is going on right now? Oh my god, let's go back to what is going on. So when we look at it from all-time data, we kind of see we have this natural sort of downtrend going on. So naturally the chart is moving down, and same concepts are going to apply on the big time frames. Okay, what broker do you use trading, not trading analysis, and why? I use any, really doesn't matter. I only trade GJ, so I follow FXCM and Oanda. I look at both, but it really shouldn't make that much of a difference if you've got a half decent broker. Okay, so FXCM, Oanda, both very good providers. So
Yeah, from my experience, you surrender. FXM have shitty wicks. You know, look for open backtest it on yourself, but FXM is really shitty for me. Like those wicks, sometimes it seems like unmitigated, but you need to look into your NT4 and then look for your chart. And what looks more similar, you stay. Does it make sense? Just use what looks most like your NT4.
yeah, okay. So check that. Thank you. Okay. So like I said, same stuff we're going to see on the small time frames. We're going to see on the big time frames. It's the nature of fractals. Okay, the market is very fractal, and it's all done using the same techniques. So you see here at the very start of time, we've got this last green candle before we got this big black one. And see how price kind of come back to this sort of region. It's the same thing going on. So we see this imbalance in this last area. So that we have this last candle before imbalance was created, and we continued lower, and price come back to that point. And right now from the monthly, there's not many areas where we could target. We could understand the fact that we've been bullish as we got to this point because as of this pullback, we failed to make a lower low. So that tells us we're trying to make a higher high. But then again, price is looking very bearish right now. But this could just be reaction to continue. This might not be the major structure point. We might be waiting for that major structure point to actually take out this low within the same swing. So there's a lot going on. You can't really gauge what's going on. So let me go to the 1 week. Yeah. See if we can see something a little bit more clearly. Okay. So yeah, I remember we had these crazy wicks. Yeah, okay. So we can actually gauge something from this, right? We can actually understand something when we look at it like this. When we look at the idea of this is still bullish. Remember, structure is key. Structure is king. Okay, structure is king. So even though we could be looking so bearish on the all-time data, we have to look at what's going on now. And as of this point, as we reacted from the supply level, we failed to make a lower low. So that tells us that bulls are still in strength. And the fact that we've taken out this, remember, when price reacts, it's going to react off areas of where the banks last got in and imbalance. This would have been this area. This is our last point of supply. and prices broke straight through it. So this tells me that we're bullish on this pair. So the 1 week has provided us with quite a bit of data. So what we could understand right now is look at actually what's happened. We've had these nice structures, okay? But where's that last area where we could see the banks might have got in? Where can you see imbalance? Like, where can you see imbalance in this chart? And I can see imbalance right here, okay? So for me, this is imbalance. And it doesn't mean when it gets here we buy. What it means is this is an overall direction for us to be getting to right now, okay? We could be anticipating price to get to this point. It doesn't mean we get here and we buy, because this could just be internal liquidity for price to come back here for the actual buy. But that's not what we use big time frames for. We use big time frames to understand where price may be trying to go. And given right now, if I went to the daily, we'd be on a nice downwards moving structure. We could be targeting this low. We could be targeting this imbalance, sorry. We're trying to fill this imbalance before we continue going up or continue to go straight down. But it doesn't matter whether we're bullish or bearish on the monthly. All we understand is, for now, we're trying to get to this point, okay? We're trying to fill this imbalance. So when I go down to the daily, we can kind of see the structure going on. Yeah, okay. So we can kind of see this bearishness going on. When we get something like this, okay, this is cool. I want to go through this. When we're looking at GA, why did this happen? Like, why did this happen? And it's because we had supply right here that we could call unmitigated. Remember how I said we have these areas before we get these big black candles? We kind of get that green candle that signifies this is the last point where the banks were buying, okay? And we use the open of the green candle, remember? So the open of this green candle is where I've marked out, and then this top we just use the wick next to it because this is actually drop base rally, okay? Or we could call it an institutional candle or order block, okay? But again, candlesticks is tomorrow, not today. So look at this for a second. What has price done? It's come back once, kind of tease it. There was also lower supply that was on a smaller time frame, so they've teased it. And what have they done? They've formed opinions. They've come back to this region enough times to form opinions. So when price got to this point, what are people trying to do? What is there a lot of up here? A liquidity, right? There's a lot of stop losses. So what the banks have done have just simply made it look like with well, they've took stop losses from these guys and then continued price going down. They've made it look like to a lot of institutional traders that have now broken structure and it's time to buy down here. You can pull out your fibs and be like, right, we're in that premium pricing, we've broke structure, we're now bullish, let's buy. It doesn't work like that, because when you can anticipate price needs to come back to supply to take this liquidity to continue going down, you're not going to get caught out in these silly little buys you're trying to get in, okay? So people are going to think that's a break of structure, but really it's just continuing healthy price action. And then right here we have really nice price action. And I'm guessing right now, what is golden rule, right? When we kind of take out a low, expect reaction. When we take out, say we're in uptrend, okay? When we're in the uptrend, as soon as we take out a high, expect a pullback. So yeah, looking at this, I need to do this because I can't click off of that. So looking at this, given that this wick has kind of taken this low, and even this point it could have taken this low, whatever the major structure point is, we're now getting some type of pullback, okay? So you might ask yourself, where does price want to come back to? I can't see any clear imbalance or places where the banks got in, which is fine, okay? Like, think about
Look, if you go to Wanda, you're gonna see something.
Is it different on a window? Okay.
In my opinion, yeah, even the last this
okay.
area.
Nice. So that
You're gonna see the last area.
Let's have a look. Maybe Orlando we can. But I was gonna go down to small time frames anyway, so I can see. But yeah, this one might be better.
Yeah, look. Now you see this one better for me.
Yeah, definitely. So when we look at what's going on, and given we're in a downtrend, we're targeting that imbalance area on the monthly down below. So what we're kind of anticipating is for price to continue bearish, okay? Oh, didn't mean to do that. We're expecting this sort of thing, okay? Get rid of these. Delete. Yeah, thank you. So what do we expect when we're looking at downtrend? We expect pullback, we expect correction, and an impulse, the continuation of this bearish structure, okay? So let's go to the 4 hour, okay? I think that's what's going to show us best right now. And we're going to see a lot, don't get me wrong, we're going to see a lot of price action. So right now, I can already see stuff, okay? So when we're looking at what's going on, when we're expecting that kind of pullback, what can we see? We can see places that are actually unmitigated, okay? we've got one here. We've got this last area where the banks bought to sell as unmitigated. Price hasn't come back to close orders here yet. So this could be an area where price might want to sell off, where price might want to continue bearish. And there's a couple of different ways. There's a couple of different ways you could use this. Okay, being unexperienced, what a lot of institutional traders would do is simply set a pending order right here and you sell it to the low. Okay, that's what they do, and they might make a 1 to 6. They might, but there isn't very much confirmation. Okay, so what you could do is you could either wait for a break of structure, but that is a lesson for another day, or you could use this area as reference. You could use it as, right, we're coming to this point. This is where we're trying to get to. So then you can look for buyers on an even smaller time frame. So right now, what can I see? I can see healthy price action. I can see where prices come down, whipped down, whipped down, whipped down. I can mark out what we'd call our order flow. So we got this last one. I got closed by this black candle, and then we got this black candle that got closed by this. And now what do I see? I see this last area, or even to break it down, I see this last candle down here. This last drop base rally candle that is unmitigated. So what I might do, or what I would do, if this was my pair that I traded, when market opens, say for example, we're all the way up here and we took out all this supply, showing me really true strength of the bulls, I'd expect a pullback to fill this imbalance and come back and close at this candlestick, okay? Me personally, I think I would use the open of this last candle. We're still on the 4 hour, okay? And then stop loss below the wick, just to be sure that I'm getting in, okay? So what you can then do is you can just put your position marker here. You could even just set a limit because we're on the 4 hour. And then we could target this area of unmitigation where price hasn't mitigated yet. And don't get me wrong, there's more unmitigated supply where price could come to up here, but you're not going to see it clearly because you guys aren't very experienced, okay? Because what you could even go and see is this right here. This candlestick, they created this imbalance, and there's all this kind of failed attempts to get back up here. We could see as inducing liquidity, okay? So that could be a long-term target, that up there. But to play things safe, you could enter on the last point where the bank sold to buy to fill that imbalance, come back to that last black candle that took liquidity, because even you can still see it. As well as mitigating and closing orders here, what has this done? This has taken liquidity from all these buyers that are right here, all these people that were too impatient to wait for the buy, have orders here with stop losses all in this trend line sort of region. I don't know if you guys can see that, but right here, there's stop losses all under here. So as well as closing orders on that sell to buy, as well as breaking even on that sell, they've taken even more liquidity to just continue the push up. And this is what I was explaining as liquidity creates structure. They take the liquidity to continue the structure, okay? So this entry would just be continued structure. It would look like this. Continued. Continued. So then whenever it wants to, make the push to get up to our first area of interest. And we don't have to just sell when we get right here. You wait for confirmation, you wait for strong rejection and break a structure. But this is an easy trade. So if you guys want to test the theory, we'll use this. I'll send it into the chat and I'll pin it, and we can come back next week on our next Saturday session and we can see what happened, okay? You can see how this played out. But this is what I'm looking at right now, okay? We've got that rejection and this is our next point of demand, okay? This is our last demand candle. So what I'm going to do, send this into the chat and I'm going to see how it played out. And what is also going to happen, guys, is we actually have a signals chat running where there's going to be 5 signals sent out a week on any pair, on any time frame. But there's a small cost to care. It's going to be $30 a month if you do want to join. But if it's something you want to think about, it's up to you. Because the idea for me of the signals chat is I'm not in this to make money, okay? Trading is where I make my money. But I don't want to be, I want to at least be being smart about this, if that makes sense. I'm giving away a lot of free value, taking time out of my day every day. So for you guys, it's an opportunity to make money while you're still learning, okay? It's an opportunity to earn while you learn. So while you're still learning, you can be grabbing signals, seeing the what's the word? Not opportunity, seeing what word am I thinking of right now? I would just call it opportunity of what the strategy can bring you, okay? So I'm going to send this one out into the Telegram chat so you guys can come back and see the success rate of how we trade. But there is also going to be a signals chat. So if that does interest you, DM me and I can get that sorted for you, get you added into the VIP chat where there is signals actually sent out. One more thing I want to add while we're talking about marketing is if this is something you have a lot of time for, this is something you really want to invest your time into. The guy that taught me this, I'll forever look up to him as my mentor. He has his own team, right? He's his own team. I'm pretty sure it's like a $500 entry fee, but it's a lifetime. Once you paid it, you're in, and you could be on his lessons every day, going over this exact same stuff, but in a lot more detail. It's going to be a lot more complicated, but you kind of need base knowledge to understand. You need to have quite strong foreign exchange understanding if that's something you want to do. That's why I kind of recommend you stick at these sessions for a bit longer, and if you want to take it further, I can put you in contact with a very amazing mentor. Okay. So let me just repeat that. Signals chat, $30 a month. DM me if you want to be involved with that. And also, there's extended education on this if you want it. Okay. So back to the charts. Oh, it's such a dry throat right now. Sorry. What we can do for the meantime is go through some more pairs and show you this exact same stuff. Okay. So what I'm gonna do is let Peter take the stage right now because I've got an extremely dry mouth. But
Yeah,
yeah, hope you
let's
guys
go.
gained some value, and I'm gonna take Peter to the stage. Thank you guys.
Yeah, so let's go. I'm just gonna cover again what Lucas said, but gonna show it in the way how I was learning it. So I'm gonna get you through the basics again one more time. So Lucas was mainly talking about. I'm sorry. Lucas was mainly talking about mitigation and imbalance, about those meanings. So we now know what is the mitigation. It's just a mitigation that they are returning to the price to make their order to be on the zero, to be on the break even, and they're adding more sales. So the definition of the mitigation is where the block support or resistance failed. The market makers then return price to the failed block, mitigating their already positioned drivers in price. So when I'm gonna show what it's mean by, I'm gonna show you this. We have a price which is going higher, creating